Welcome to another episode of Terminology Tuesdays, and welcome to another episode of Terminology Tuesdays brought to you by the Gray Area Report. Last week we defined what financial markets are, a centralized location for buyers and sellers to meet up and determine what a price of something is. But a price of what exactly? In most cases, it is a price of a stock or a bond. A stock represents your ownership of a company amongst other shareholders that are just like you. On the other hand, owning shares of a bond is representing your ownership of a company's debt with the expectation that they will pay you back. Let me give you an example of this. Back in the day, my boy D, a good friend of mine, was a thriving entrepreneur, and his latest venture, his amazing fashion company called Bad Boy Behavior. Now, D came up to me one day and was like, listen, Emily, my company is about to pop off and you really need to invest in it before it's too late. And besides the fact that he was my friend, I wanted to do my research. So, looked up the numbers, see what's good, and realized, hey, you know what? This company has a lot of potential to grow. I should totally invest. And so I gave my money to Bad Boy Behavior, and in return, Bad Boy Behavior gave me a share representing my ownership of that company. Throughout time, the stock had flourished. I was super happy because I was getting regular dividend payments, which is basically just when a company's profits are distributed to its shareholders whenever they deem appropriate. And everything was peachy keen. But then, Bad Boy Behavior totally tanked. D was like, I don't know what happened. Oh my God, Kendrick Lamar promised he was gonna pay for this fur jacket he wore on the cover of Rolling Stones and then never did. Again, this is hypothetical. And, I don't know what to do. I overshot my earnings estimate because of Kendrick Lamar. Well, is this actually really true? Or were you just over cocky about the situation? He basically begged me to invest more money in the sense of a loan. I would be giving money to Bad Boy Behavior, not to own, but rather to give a loan out to with the expectation that I would be paid back in full, plus some interest to make it worth my while. So after D begged and pled with me, I basically decided, you know what? Bad Boy Behavior has been doing me dirty, and I'd rather not throw more money at it. Despite the fact that corporate bonds are more safer than equities typically because it is a promise of that return rather than, an expectation of future earnings, I still wasn't willing to put in all of that money. And in fact, ended up selling my shares of Bad Boy Behavior because you know what? Those future expectations of profit were not cutting it anymore. So the bond and stock market is much more nuanced than this, but an important thing to recognize is 3 major points. 1, as we mentioned, bonds are usually way safer to invest in than equity because again, it promises return. It promises it's going to pay you back and it is contractually obligated to do so, plus interest, plus a little extra on the side to make it worth your while. On the other hand, stocks, there's no certainty. So therefore, they are riskier. My expectations about Bad Boy Behavior flying high completely derailed upon a little news that their earnings were not where they thought they'd be. Second point, bonds distribute interest and stocks distribute dividends. We already went over this. And third and final point, stocks will typically trade on the New York Stock Exchange and other centralized locations where traders and buyers and sellers can pass around those shares freely in the secondary market. And then alternatively, bonds are traded over the counter, meaning through an individual transactions via a network of dealers. So, some 3 things to keep in mind when you go in thinking about investing versus stocks and bonds. Thank you so much for listening, and I will see you next week on Terminology Tuesdays.